I hope you enjoyed the original part of this broadcast, which showed this chart on a tick by tick level. And this is going back to 1961. When we draw trend lines, we can use parallel lines to determine what the rate of increase or decrease happened to be. And for the first few years, it was in an uptrend, something in the area of this in here. And we had some pretty big gains, seeing the silver market go from 35 up to 800. And then it was really correcting through time with the slope towards the downside. Something in the area like that. And it was a decent amount of time that gold was correcting through this level. Pretty much 2 decades it did this for, which is quite a while. And we've now been back in an uptrend for the last so many years. Let me just draw in this line again. There we go. So the uptrend now is something in the area like that. And I can draw a parallel line for the support level. But if we take a look at this chart, or at least the difference of this uptrend in here and this uptrend in here, what I notice is the difference from the support to the resistance is much more. The gap is closer today as it was back then. It also really isn't going up at the same rate of increase, I don't think. As you can see here, it's going up at a slower rate of increase than it did back in the 1970s. So if it happens to go in a parabolic move upwards or in a hyperinflation sort of period, it has no choice but to break this uptrend to the upside. Alright, so now what we're going to do is I'm going to reduce some of these candles and really focus more towards on this bull market. Pretty much start from around here and then take a look at this bull run. Then we'll go back to this chart again, but we'll use a line-based system the next time around. And this is the same chart going back to January of 1999, which really shows the bull market that we've been going through very well. No signs whatsoever of a bubble as of now. And this part we're going to do some trend line analysis. We'll connect the original low points. And if you get something like this, you can see that the original trend line, well, it's not even a concern anymore. Even if we do something in the area of, say, this here, even this trend line isn't really doing so much. So I'm going to draw some parallel lines. For me to do this on this drawing software, I'm just going to draw over the line and then move it. Something like this. And we can see that the resistance part here became a level of support. When resistance is broken to the upside and becomes support, that's very strong. And that's exactly what has happened here. As it was resistance on 1, 2, 3 occasions, support here a few times, and here on the 2008 bottom crash. We can draw another trend line, and like I said, all I do is match the previous one, find the resistance point, and I found it in here. And within this one here, we can see how it's been holding up very well to the point where I can make another trend line. And where am I going to connect it to? This top point here. And there we have it. And if we break this resistance point on this one here, then maybe what you'll have to do is put in yet another line and keep on doing it as long as the buyers remain in control for this market. Now what we're going to do now is we're going to switch this up to a line chart and work with some Fibonacci. We'll go right back to the original chart of the last 44 years. And we're going to start off with the Fibonacci from the 1980 highs and the lows of $35 per ounce. These are exponential calculations because when the numbers get really big, it is, in my view, the best way of observing charts and numbers for exponential growth. And when we're in a hyperinflation scenario, which we're pretty much getting close to entering towards, it makes it a little easier in evaluating the numbers. Anyway, nonetheless, the 38.2% Fibonacci on an exponential level from the 35 lows and the 850 highs was 250, which was tested on two different occasions. The 61.8 level of 118 was never ever tested. Now the silver market, it tested the 61.8 from its 1980 highs and its 1972 lows, but that was silver. Silver has traded a little bit differently, but within the same sort of direction, meaning having big runs in the 1970s and then going down, consolidating for that of 2 decades, and then have been bullish for the last decade or so. The calculations for this upside regards the lows of 35 and the high here of 197 and a half. The 161.8% level, which is roughly $300 per ounce, was almost tested here, tested successfully here. It pierced below it on this level and was used as resistance before finally getting above. When it went below it, it found support. And the 261.8% level, which is roughly $460 per ounce. It got no problem getting above it here, sort of like it did here. When you break through a key Fibonacci level, well, you usually go to the next one. We'll get to the 423 in a moment. That's 723. And, well, gold got up to, on an intraday level, 850. You don't see it on this chart because these are monthly close only data. Regardless of the fact, though, as the market was consolidating throughout the 1980s and 90s, this level was resistance on a couple of occasions. Again, here before it finally broke out, the 723 level was actually resistance in here. It pierced above it, although this chart says it pierced below. And just recently it got above it in here. It came back to it during the 2008 crises and then got above it. 1150 is the next one. It really has gotten above it very well, that when you break through these levels, I have to think the next one's coming, and that one is upwards to around 1837. Now that could take a decent amount of time, maybe a week, well not a week, but maybe a few months as a time duration. It's really hard to try to predict when these moves will happen, but I do like the way it is held above this level, and the trend is just magnificent. Now we're going to switch this to a daily chart. We have the same numbers that we had from the previous chart in here, the 1148 mark, the 723, and the 460. This will make things look maybe a little bit clearer. And the 723 was a perfect top. Let me just get rid of the color red. Switch it up with the black, maybe. So it was a perfect top of 723, which I thought is quite impressive. And then it got above it very nicely the second time. Like I said, it was support on the way down. This 1150 level, it was a little bit of resistance, but it held really well. When a level is supposed to be resistance and it originally pierces above it, like we can see right in here, and then really doesn't, it falls below it, yes, but it doesn't have another leg below it. That's a very healthy consolidation in here. And well, the market's obviously going higher, which is telling me that 1800 should be coming. And like I say, it's hard to predict for the variables of the whens these things will happen. But moving on, we will I want to talk about this inverted head and shoulders pattern, which I was talking about before. It's the one in here. And some people were telling me, oh, it can't be an inverted head and shoulders pattern when you're in what was an uptrend coming in. And to me, that was complete nonsense. In fact, I like the inverted head and shoulders pattern more in an uptrend, as I like the head and shoulders pattern better in a downtrend. And the pattern was the left shoulder, the head, and the right shoulder. It's where the first leg is not as higher than the next one, and then the next low is higher, basically. And all this was a consolidation through time. Now, some people like to calculate a price objective by taking the level of the bottom, which in this case is 700, and the breakout level, which was basically 1,000. 1,000 was a big mark, so that would be 1,300. But that really isn't my style or my strategy. As, for example, if you have a head and shoulders pattern like this, and the neckline is 5, and the top is 15, well, okay, so we're going to lose 10 points on it. So we're going to go from 5, lose 10 to -5, and that really can't happen. But it lost 2/3 of its value. You lose 2/3 on 5. That would be a bit, but a 1 1/3. Therefore, the gain from 700 to 1,000 worked out to about 42%. 3 divided by 7, that is. So from 1,000, 42%, that's about 1420, which pretty much is exactly where this top has come into play. And if we draw a straight line at the neckline, let's just do it. Let's find the best one that we can. I'm not going to do the original tab. This one is the best, I think. It's tough to call. Anyway, what we'll do is we will take the length of the bottom right to the neckline, something like this, and then draw it out. Now this already is a logarithmic chart, so therefore it should be pretty much right on the ball. And as you can see, it is. Now just because the objective is to 1,400, that doesn't mean that's where the market's going to top and that's it for gold. No. It is an area where you'd expect it to encounter a level of resistance. It has encountered a level of resistance. If this is it for retracement, then this is very, very strong. And this is another key bottom, meaning we come back up to this next key level of 1,400 and change. Then the odds would favor a break of this level and then towards the next area, which would be towards the 1,1600. But to see this better, we'll look at the shorter term time frames. It's been a wild ride over the last year within this market, and it looks now within this 50-day moving average as if the market wants to roll over, and it might. After all, we had this support at this magical line of 1326.72, and we've rallied. Now the 50-day moving average is starting to decline, and overall it's more of you can make the different name patterns, one of which can be that of a descending triangle when you make a straight line here at 1326 with this downward trend line. Maybe even the same 1326 line in coordinates with this 50 average. Something's going to have to give, either a break below this level or it establishes its current trend of going higher. Now, at breaking below this level, the most logical spot for support becomes 1261.38, or roughly 1260. And that is because that is the 61.8% Fibonacci within the most significant lows that this market's had, which is at 1155 from the summer of 2010 and this high of 1432. So that'd be the more logical place where it would come into tuition. Reminder that all these prices mentioned are in Federal Reserve notes. Sort of like, I wonder what happened to Germany. Remember, history always repeats itself. When a civilization debases its currency, all the currency will once again come chasing that same tiny little pile of metal, and gold and silver will revalue themselves measured in those currencies.
This will happen to the US just as it did every empire in history. Those who recognize this stand to become wealthy beyond belief.
And in conclusion, you'll hear oftentimes about deflation or the prices going lower, and it may happen. And just like it was in 2008, a retracement within the price. But fiat currencies cannot stand the test of time and either will have to peg itself to real commodities, real assets, or go through the means of hyperinflation. Now, it's very difficult to determine the timing and exactly how it will come into being. But what isn't all that difficult is understanding that the currencies created today are created practically out of thin air, which go against the general people. And at some point, even when using logarithmic charts like the one you're watching, things can get out of control. And when inflation to a hyper level comes into play, well, things usually explode a lot faster. Take care.